Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that has bounced beautifully and precisely off its uptrend line support here. Market participants stepped in here as the market was approaching this very important zone of support at 3,900 points. Also, as the market was printing these bullish divergences between the price that was making a lower low, RSI making a higher low, the same setup that we had back in June that marked the significant bottom in the market. Now, we usually try to stay away from looking too much at the short-term risk reward at gameoftrades.net. But when we see a very attractive risk reward from a technical standpoint, with price clearly setting up for a bounce, that is something that we'll be highlighting as we see it. Now, the big question is whether these divergences are going to play out for a massive run on the S&P, leading to a breakout of this downtrend, or if this is just going to be another failed rally attempt, similar to what we had in May here, that triggered an impulsive run, certainly, but was very rapidly rejected. I think that's definitely the question that a lot of people are asking in the face of this massive volatility that we're seeing in the market dropping down 24%, just to rise 20% and then retrace a big part of that move. I think a lot of people are getting crushed by volatility, and a lot of people are very nervous. If you think about the market psychology right now, we've been on a 13-year bull run on the S&P 500. People know that's not going to last forever. We know that's not going to last forever. It's completely ridiculous to think that stocks go up forever. If we take a look at market history, we know that's not the case. Yes, in the long term, the market goes up, but you can be stuck with underperforming stocks for 10 years. And if you're in stocks at the wrong moment, it can be very painful to watch with a huge amount of wealth destruction in a short amount of time. We've had multiple periods throughout history where we've seen the stock market bring about a lot of pain. And so after this secular bull run here, investors are left wondering, this is going to end badly. This is going to end with a significant retracement of the gains that we've made throughout the last 13 years. But the big question is that going to happen now? Are we going to break that trend line and begin to look forward to much lower lows on the S&P 500, which actually seems to be the consensus right now? A huge number of market participants seem to agree on the fact that we're entering a recession, that the Fed is tightening, and so the combination of those factors are going to lead the stock market much lower in the near term. That is the goal of this channel. That's the goal of our service at gameoftrades.net, is to evaluate the market every week, look at the data, look at history, and see where the opportunities are, whether that's on the S&P 500, on the bond market, on commodities, on crypto, on commodities, whether that's on the broad market, the S&P 500, in industrials, financial sectors, energy sectors, bond market, gold, other commodities, industrial metals. We try to take a look at everything and give you the complete picture. If you are interested in following these crazy markets with us, don't forget to smash that subscribe button. Also, if you enjoyed this episode, don't forget to click on the like button. And now, without further ado, let's get right into it. So the topic of this video is going to be focused on a specific chart, and that is XLU divided by the S&P 500. Now, XLU is the utilities sector. It's often seen to be a defensive sector of the S&P 500. Now, what does that mean? That means that if you take a look at the correlation coefficient with the S&P 500, this is going to be inversely correlated to the S&P, or mostly inversely correlated. When this indicator is below that zero line, it means correlation is negative, meaning that when this ratio is going up, that usually means the S&P 500 is going down. And you can take a look at that by superimposing the S&P on this chart. Usually, most of the time, tops in this ratio, XLU divided by the S&P 500, coincide with bottoms in the stock market. And you can see again here a top on XLU, a bottom in the stock market in 2010. In 2011, top in XLU, bottom in the stock market. 2012 again, and I can go on like this for all the data points, but by now you should be convinced that they have a very strong inverse correlation, and it also works in the opposite way. Bottoms in XLU more or less coincide with tops on the SP 500. That worked in 2021. This was a bottom in XLU, local top in the stock market, bottom in XLU right here, local top in the stock market. I think you're starting to get the gist of it. So if we take a look at the technical picture, because technicals do work on ratios, you have support, you have resistance, the same dynamics work on these ratios, right? And so you can take a look at what's happening here with this trend line being broken. If you're good at spotting patterns, you'll be very concerned that this is a head and shoulder pattern right here. So utilities breaking out of this head and shoulder pattern. Could that signal that we're in for a major run, major outperformance of XLU divided by the S&P 500? That would fall in line with a very bearish narrative, with people expecting much lower lows on the S&P 500. Michael Burry would see this as a beautiful head and shoulder pattern breaking out, and the beginning of the second phase of this bear market starting out now. And that is objective to think about it like that. Head and shoulder patterns are not perfect. Sometimes they can fail, sometimes they can break out and reverse back down. In fact, that's a pretty bearish sign. So when you're dealing with such a massive pattern, you want to identify if there's any overhead resistance that could negate this head and shoulder pattern if price is unable to break that resistance. And this is the price channel that we're currently looking at for XLU divided by the S&P 500. This is a secular bull run channel, I call it, because the ratio has been trending within that channel ever since the very beginning of the bull run, right? And you can see here, this was a major signal right there with XLU divided by the S&P 500 breaking down below this trend line here, uptrend line support that was respected throughout the entire bear market in 2008, bounce, and right here, that was your confirmation. We were no longer in this secular period of downtrend, and the market was actually going risk on at that specific moment. So this is what I really call a secular bull run channel that's been respected, that's been doing a great job at capturing the highs on the S&P 500, for example, this 2010 high, and the major lows, for example, that 2011 low on the S&P 500. So this price channel, this bearish price channel on XLU has been acting as this sort of risk-off range that has been containing market volatility throughout the past 13 years. So if we're talking about objectively assessing whether or not this secular bull run has broken down, we need to put weight on this price channel. And the fact of the matter is that it hasn't broken yet. We're still below that resistance line. XLU divided by the S&P 500 is still trending within this bearish price channel. So if you're an optimist, you're looking for this to act as resistance and to be respected as resistance. If you're a bull on the S&P 500, you want to see that reject and the XLU to SPX ratio breaking back down below this trend line here, failing that head and shoulder pattern. If you're a bear, what you want to see is definitely not a rejection, but a breakout, a clean breakout. We're currently in favor of seeing a rejection right now, and we are expecting a durable bottom to form on the S&P 500 within the next few weeks if it hasn't already occurred in June, which could very well end up being the bottom on the S&P 500. But looking at this chart, we have the XLU to S&P 500 ratio approaching that resistance, suggesting we could be in the final stages of this correction. Now, of course, objectively, right, if you see a breakout like this, that would be extremely concerning, right? Because you're losing these structures that have been in place for the last 13 years. You're losing that, and the market clearly changing behavior relative to anything we've seen. That would take a lot of selling pressure on the S&P 500 for that to occur. I want to stress that that it has not occurred yet. In fact, if you take a look at similar tops, you've had divergence form leading up to that top, which is a similar setup to what we have today, right? The ratio moving higher with the RSI moving lower, ratio moving higher with the RSI potentially making a lower low. That would be an interesting setup. Now, from a macro standpoint, should we expect a breakout of this secular channel? One of the things that is often cited to be the reason for the next leg down of the stock market, for example, Michael Burry saying that we should expect that the stock market is only halfway down, is the earnings collapsing, right? And in fact, so far it seems like these people who have been calling for that are looking quite smart, because negative revisions actually began over the last few weeks. In August, you began to see negative revisions on earnings. And so that has probably been a headwind to the market. Now, of course, these are expectations. So earnings expectations are deteriorating here. But I want to quickly show you our thought process on this, because we saw an earnings boom in 2021. In December 2021, we had earnings growth absolutely skyrocket here. Year on year, EPS change reached levels that we've only seen a handful of times since the 1900s, right? So that's very important. We saw such strength in 2021. Does it make sense that we're already seeing contraction in earnings? And this is just a quick teaser of the article that we actually posted earlier this week. We put out an in-depth article on earnings, really diving into the details, looking at the entire picture and what we should expect earnings to look like in the next few months. And what we found is incredibly surprising. And I think this is really going to be the key information to understand what is currently happening in the market and what's going to happen in the market over the next few months. It's a fantastic and complete piece. So I do strongly recommend that you go and check it out if you haven't already. And so very briefly here, if you take a look at historical episodes where you saw a similar boom in earnings, you had 13 of them throughout the last 100 years or even 122 years. In almost none of them did you see a contraction in earnings following the big boom. In the vast majority of episodes, you saw the earnings decelerate for obvious reasons, right? Earnings can't continue going up like this forever, but they don't contract. And so while perhaps we do have a lot of headwinds right now, we've had oil prices that have been a headwind to the economy, headwind to spending. Inflation was very high. That was also a headwind to spending. And then there was also the idea that a lot of people had just spent all they needed during COVID and have pulled back on that spending. But that's just a temporary rebalancing. We don't think these negative earnings revisions are going to come true. If earnings are even average, right, even just average, that would be enough to create monstrous gains on the S&P 500. There's a lot of pessimism even amongst the analyst community regarding S&P 500 companies, and this is just not what the macro suggests, at least for now. Right, if you're talking about a year from now, 12 months from now, mid-2023, that could be an entirely different picture as we start to feel the real effects of monetary tightening, of having had rates elevated for an extended period of time. That can start to really weigh on the economy and lead to a contraction in earnings. But if your time horizon is the next 6 to 12 months, we think earnings could actually surprise to the upside in a big way, which would fit a lot more with a rejection of this trend line if that does end up materializing in the next few months. Let's say during the end of year, where spending can often pick up again ahead of the holidays. That could reaffirm that the underlying consumer is strong and trigger an end of year rally. Now, of course, right now seasonality is a headwind, right? And we know that September is historically the worst month for the S&P 500, and we've already suffered through that at the beginning of September, but by year end, the picture could be a lot different. Now, of course, that is our opinion. As we've already discussed many times, macro can take time to shift. While we do expect earnings to stay pretty resilient over the next 6 to 12 months, right? What happens within this month, that's going to be dictated by emotions, technical breakdowns, volatility, intermarket dynamics. That's not going to be dictated by pure macro developments. And so that's why in the short term, what dictates these moves is also what's happening on the bond market, what's happening with oil, what's happening with the dollar. And so if important technical levels are broken down like this trend line here that we're watching very, very closely at gameoftrades.net, if that gets broken down, you're losing a bullish structure. Now, until that's the case, we should expect a bounce here. We should expect the market to move back into this zone here, potentially even retesting that trend line here. But if we lose that level, the short-term picture does deteriorate significantly. So that's the nuance I wanted to add in this video. It all depends on your trading style, on your investment style, how much you weigh in the macro, how much you weigh in the technicals, and what type of risk you're looking to take in the market. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.